It is a chaotic Tuesday morning in Manhattan, and Bank of America has just set the financial wires ablaze with a warning that silver is mathematically locked in for a surge to $390 because the gold to silver ratio is on the brink of an implosion, even as the globe stays glued to the $78 handle. It is Tuesday, January 6, 2026, and the mood on Wall Street is heavy with the static that usually signals a monumental pivot in asset pricing. Sunlight glints off the glass towers of lower Manhattan as traders lock in on monitors displaying silver prices churning tightly within the $78 to $79 band. While the retail crowd obsesses over negligible $2 swings, the institutional sector has just been stunned by a dossier that landed on desks only hours ago. Bank of America has issued a report currently burning through the high-speed networks of the financial district titled the Price Fracture Report, which completely rewrites the script for precious metals. Michael Whitmer, the bank's chief of Metals Strategy, has abandoned the typical safe play forecasts analysts usually feed the public. In this rigorous analysis, he contends that silver is experiencing a fundamental structural repricing, which isn't a gamble, but a calculated certainty rooted in market physics. The findings indicate the white metal is loaded for a trajectory that could catapult values rapidly toward a range between $135 and $390 per ounce. The trigger for this meteoric rise isn't a new vein discovery or a fleeting war, but a forensic examination of the gold to silver ratio. This metric stands as one of finance's most enduring truth tellers, measuring precisely how many ounces of silver constitute the value of a single gold ounce. As the session matures on this 6th of January 2026, the ratio hovers around 59 to 1. That figure represents a massive coiled spring which Bank of America flags as unsustainably compressed compared to historical norms. Whitmer notes that during the last great silver bull run in 2011, the ratio squeezed down to 32 to 1. Should the market purely replicate that mechanical shift today with gold, steady silver would instantly re-rate to $135 per ounce. Yet the analysis ventures deeper into black swan territory by revisiting the frenzy of 1980. Amidst that legendary era of inflation and currency erosion, the ratio cratered to 14 to 1. Bank of America's quantitative team concludes that a similar compression in the fiscal environment of 2026 would drive silver to $390 an ounce. This $390 target isn't presented as a gambler's long shot, but as the product of a mean reversion that the market has executed repeatedly over the last century. The bank views the current $78.84 price not as a ceiling, but as the halfway mark of a massive cycle that is only starting to gain momentum. Investors anxiously eyeing the charts this morning are being assured by America's second biggest lender that their dread of a downturn is unfounded. The dossier stresses that historical bull market mathematics demand a reversion to the mean, compelling silver to drastically outpace gold in the cycle's final innings. This ratio realignment is crucial, underscoring just how cheap silver remains compared to its yellow sibling, despite recent gains. When the spread holds at 59 to 1, it suggests the broader market is blind to silver's dual industrial and monetary worth. History proves that when this blindness lifts, the adjustment is brutal and fast, often playing out in months rather than years. Bank of America's alert serves as a stark notice that $78 is just a brief pit stop before the ratio starts its steep dive. Traders are waking up to the fact that a push to $135 needs only a routine market swing akin to 2011. A surge to $390, however, signifies a total resurrection of the 1980 monetary playbook, where silver reclaimed its status as a premier store of wealth beside gold. This dynamic creates an asymmetry where the floor is mathematically solid, while the ceiling sits at multiples of today's spot price. The algorithms running modern exchanges are already pricing in this intelligence from Bank of America as the morning wears on. What sets this Tuesday apart is that this forecast originates from a titan of finance, not a fringe blog. Michael Whitmer is essentially warning Bank of America's clientele that fixating on silver's nominal price is a mistake. The sole figure that counts right now is the tension between gold and silver, which has been pulled to its absolute limit. As the morning bell fades past 10:30 on Wall Street, the gravity of a shift from 59 to 1 down to 14 to 1 is sinking in. It implies a wealth transfer of epochal scale from paper currency holders to owners of physical bullion. The $78 level, deemed pricey by some just yesterday, is now being reimagined as the deal of the century against a $390 backdrop. The Price Fracture report has drawn a definitive line regarding hard asset valuations in 2026. The story of this January 6th goes far deeper than simple price charts touching the massive tides of global capital. Bank of America flags a gaping liquidity void, warning that the institutional investment sphere is critically underweight in this sector. While precious metals comprise roughly 4% of calculable financial wealth, current exposure among ultra-wealthy players is alarmingly scarce. Data shows these heavy hitters and funds have parked a mere 0.5% of their fortunes in gold and silver. This tiny fraction is the anomaly, fueling the immense upward pressure detailed in the analysis. Whitmer's team at the bank has run portfolio optimization simulations for the 2026 economy. Their math indicates that a portfolio built to survive current inflation and currency hazards demands a 20 to 30% stake in gold and silver. The gap between today's 0.5% ownership and the suggested 20% target equates to trillions in potential inflows. This is the proverbial wall of capital waiting to flood a physically tiny market. If these fund managers shift even a sliver of their assets to align with the Bank of America guidance, the shockwaves would be massive. A move from 0.5% to just 1% would effectively double the global demand for investment-grade bullion instantly. The issue highlighted is that the physical supply simply cannot support a pivot of that size. When an institutional giant moves billions, even a minor, 1% adjustment necessitates buying millions of silver ounces. The silver trade is notoriously tight and illiquid compared to bonds or equities, meaning big tickets send prices vertical. This liquidity vacuum is the main engine behind the forecast for triple-digit silver and potentially $5,000 gold. Bank of America is alerting its top-tier clients that they are trailing the market and must rapidly build positions before the opportunity vanishes. The model advising a 20 to 30% allocation is a stark break from the classic 60-40 stock-bond mix. It acknowledges that the financial terrain of 2026 has been irrevocably altered by debt and currency debasement. In an era where government debt is viewed with skepticism, hard assets like silver emerge as the essential ballast for a secure portfolio. The report notes that as high net worth players finally grasp this dynamic, the scramble to secure physical bullion is going to trigger a massive logistical choke point. This congestion is the exact catalyst for a price melt-up caused by billions of dollars attempting to force their way into a market cap that can barely accommodate millions. That 0.5% ownership figure is arguably the most aggressive signal in the entire dossier as it measures the current apathy right before it snaps into panic. It is a common misconception among investors that a spot price of $78 implies the institutional giants are already fully invested. However, Bank of America's data shatters this assumption, revealing that the smart money has scarcely begun its accumulation phase. The overwhelming majority of endowments, pension funds, and family offices hold virtually zero exposure to silver's price action. Consequently, the rally to $78 has been fueled almost exclusively by retail traders and early speculators, while the financial titans remain in the dugout. When these heavyweights finally step onto the field, they won't be picking up a few coin tubes. They will be acquiring entire mine outputs and securing complete vaults. A universal portfolio allocation of 20% is mathematically impossible, necessitating a price surge to reach equilibrium. At $39 per ounce, the total market capitalization of silver would expand sufficiently to soak up some of this liquidity. Thus, the appreciation is not merely speculative froth, but a mechanical necessity to facilitate the entry of institutional wealth. This narrative of a severely underallocated corporate sector creates a critical sense of immediacy for anyone reviewing this analysis on a Tuesday morning. It indicates that the window to acquire metal at $78 is closing rapidly before the financial leviathans breach the surface. Michael Whitmer is effectively signaling that holding out for a correction is a hazardous gamble right as the liquidity void is being bridged. The massive ocean of fiat currency, seeking a safe harbor in tangible assets, completely overwhelms the available inventory of bars and coins. This represents the specific financial dynamic that transforms a gradual bull market into a vertical price acceleration event. Bank of America has highlighted that the global market is underweight in the solitary asset class destined for a monumental repricing. As the trading session progresses, the realization is spreading that the 0.5% niche is on the verge of becoming the 20% consensus. The third and arguably most vital pillar of the scenario developing on January 6, 2026, is the geological reality beneath our feet. The bank emphasizes that 2026 represents the fifth straight year of a structural deficit in the global silver trade. We're not looking at a transient supply chain hiccup, but rather a profound geological and industrial scarcity that has been compounding for half a decade. The report details the mining sector crisis, projecting that output from the top 13 North American precious metals producers is set to contract. Estimates point to a 2% production slide this year, flying in the face of skyrocketing spot prices. This anomaly contradicts standard economic theory, which dictates that rising values should trigger increased supply as companies rush to extract resources. The primary reason this reaction is absent stems from the escalating expense of operations, specifically the all-in sustaining costs, or AISC. The data shows that sustaining costs for gold production have climbed to $1,600 an ounce, acting as a bellwether for the sector. Silver producers are grappling with identical inflationary headwinds, ranging from diesel prices to skilled labor wages and the cost of heavy machinery. We have arrived at what experts term peak silver, a juncture where humanity is consuming the metal faster than it can be unearthed. Shafts are going deeper, or quality is degrading, and regulatory red tape is tightening, choking off new supply lines. This establishes a concrete support level beneath the current $78 price tag. Since the marginal cost of extraction has spiked so aggressively, producers are financially unable to offload inventory at discount rates when every ounce requires record capital to produce. Moreover, the industrial appetite for silver in 2026 has surged, driven by the Green Revolution. The metal is a non-negotiable ingredient in photovoltaics, electric drivetrains, and high-tech circuitry, all sectors that are in perpetual expansion. This deficit is systemic because demand is price inelastic. Manufacturers are compelled to secure silver at any cost to manufacture their products. Merging a 5-year shortfall with a 2% output drop formulates the perfect recipe for a supply crunch. Bank of America highlights the absence of any significant new deposits, prepared to rescue the market. The cycle to discover, permit, and construct mining infrastructure spans 10 to 15 years. This development latency implies that even if the price hit $39 tomorrow, there would be no immediate flood of new supply. The analysis depicts an incredibly tight physical market where inventories are being depleted to feed unyielding industrial consumption. Market participants are finally reckoning with the reality that futures contracts cannot manifest physical silver. The divergence between paper valuations and tangible scarcity is snapping in this 5th year of shortage. Michael Whitmer contends that these supply-side limitations serve as high-octane fuel for the demand side, momentum generated by institutions. When a tsunami of capital crashes into a vacant vault, the price per ounce is the only variable left to adjust. Consequently, mining firms are evolving into premium assets as they control the sole source of fresh metal in a famine-struck marketplace. The production slump signals that the low-hanging fruit has effectively been harvested and devoured by the global economy. What remains in the earth is challenging, capital-intensive, and slow to recover, guaranteeing the deficit continues. This supply-side constraint provides the foundational logic for the $39 target. We are moving beyond financial ratios to a story of absolute elemental scarcity. The $78 level is underpinned by the tangible expense of extraction and the voracious consumption of industry. As twilight falls over New York on this Tuesday in January 2026, the Bank of America directive is unambiguous. We are experiencing a rare triangulation of ratio, normalization, institutional rotation, and physical depletion. The trajectory toward $39 is built on the mathematical inevitability of supply-demand asymmetry. For those monitoring the ticker, this narrative has evolved from conjecture into a verified blueprint for the future of currency. The age of inexpensive silver has concluded, and the cycle of structural repricing has formally commenced.